Welcome to the Battlefield Trading YouTube channel. In today's video, we're bringing you a complete guide to the MACD indicator. Here's what we'll cover. We'll start with the basics. What is the MACD and how does it actually work? Then, we'll break down the key components, the MACD line, the signal line, and the histogram, helping you understand what each one means and how they interact. Next, we'll dive into real-world trading applications, including the slope of the histogram, MACD crossing the signal line, MACD crossing the zero line, MACD pulling back to the zero line, and divergence. You'll learn how to use these techniques to spot trading opportunities with more confidence. And finally, we'll combine MACD signals with other trading concepts to build 3 practical strategies you can apply in different market conditions. Let's get into how to use MACD effectively in real trading. Right after this intro.
Warning.
Let's start with the question. What exactly is the MACD indicator? MACD is a lagging indicator widely used in technical analysis. It was developed by Gerald Appel in 1979. The MACD consists of 3 key components: the MACD line, the signal line, and the histogram. Let's take a closer look at each one. First up, the MACD line. This line helps identify the market's price trend. It's calculated by subtracting the 26-day exponential moving average, EMA, from the 12-day EMA. In simple terms, when the 12-day EMA is above the 26-day EMA, the MACD line sits above zero. When the 12-day EMA drops below the 26-day EMA, the MACD line moves below zero. Next, we have the signal line. This is the 9-day EMA of the MACD line itself. When the MACD line crosses the signal line, it can be an early sign of a potential trend reversal. And finally, the histogram. The histogram shows the distance between the MACD line and the signal line. This gives us a clearer picture of the trend's momentum. When the MACD is above the signal line, the histogram displays green bars above the zero line, indicating bullish momentum. When the MACD falls below the signal line, red bars appear below the zero line, signaling bearish momentum. So those are the 3 components of the MACD line, the signal line, and the histogram. Now, let's explore how each of these components can be applied in different market conditions. Application number 1, the slope of the histogram. The slope, or shape, of the MACD histogram gives us deeper insight into the current trend. When the market is in a strong trend, the distance between the MACD line and the signal line widens. This causes the histogram bars to expand. An expanding histogram is a clear sign of increasing momentum. So, when you see the histogram growing, it's a good time to look for trades in the direction of the trend. As the trend weakens, the histogram starts to contract. This contraction signals a loss in momentum, which often comes before a price reversal or a sideways market. At this stage, it's usually wise to exit your position and wait for a new trend to emerge. Some charting platforms make histogram changes more visual by using solid and faded colors. Solid colors appear when the histogram is expanding, and faded colors show when it's shrinking. At the start of a bullish trend, you might see 2 or more solid green bars with a widening histogram. This signals strong and reliable upward momentum, a great opportunity to look for long entries. On the other hand, once the histogram starts to shrink, that's your cue to consider closing your trade. Shrinking bars suggest that the current momentum is fading, and a trend reversal or range-bound market is likely. As you can see in this example, the contraction of the histogram lines up perfectly with a period of sideways price action. After the sideways phase, price begins to move lower. At the early stage of a downtrend, we see the histogram expanding with dark red bars. If you're still holding long positions, this is your final chance to exit. These dark red bars signal that selling pressure is increasing, and smart traders will start looking for short opportunities. After a sustained downtrend, the histogram begins to contract, and we start to see light red bars. This is a sign that bearish momentum is fading. A potential trend reversal or sideways consolidation may follow. As you can see, the selling pressure weakens significantly as the histogram contracts. Now, keep in mind, This is just one of several ways to use the MACD indicator. You should never base your trades on this signal alone. Later in this video, we'll walk you through how to combine the MACD with other tools to build effective trading strategies. If you're enjoying this video so far, don't forget to hit the like button and subscribe to support our channel. And feel free to leave a comment if you have any questions, feedback, or topics you'd like us to cover in future videos. Now let's move on to the second application, the crossover between the MACD line and the signal line. Many traders rely on moving average crossovers to guide their trades. However, these crossovers often happen after a strong price move has already occurred. That means you may end up entering too late after most of the action is over. To solve this, we can use the crossover between the MACD line and the signal line. This crossover can give you an early signal of a potential trend reversal, while also offering a better entry point and a tighter stop loss. Let's break this down with an example. We'll use the 12 EMA and 26 EMA on the price chart, along with the MACD indicator below. Since the MACD is calculated using the 12 and 26 EMAs, this is a fair comparison. Here's a trend reversal, where price shifts from an uptrend to a downtrend. The EMA crossover happens right here, so your entry would be on this candle. But as you can see, price had already dropped a considerable distance before this crossover occurred. That means your ideal stop loss would need to go above this recent high, and that's quite a wide stop. Now let's look at the MACD signal for the same setup. With the MACD crossover, your entry would be on this candle much earlier than the EMA crossover. This gives you a more favorable entry point with a much tighter stop loss, a clear edge in your trade setup. Here's another example. The 12 EMA crosses above the 26 EMA right here, so you'd enter long on this candle. But again, the crossover happens after price has already made a strong move. On the other hand, the MACD crossover occurred right here, giving you a much better entry and a smaller stop loss. Although the MACD crossover can be an early signal of a trend reversal, it also tends to produce more false signals. That's why you should never rely on this crossover alone. Always look for additional confirmation. One widely used confirmation signal is the crossover of the zero line, which brings us to the third application of the MACD, the zero line crossover. The zero line acts as a reference point in the MACD indicator. When the 12 EMA crosses below the 26 EMA, the MACD line moves below the zero line, signaling that the market is shifting into a downtrend. Likewise, when the 12 EMA crosses above the 26 EMA, the MACD line moves above the zero line, signaling that an uptrend is starting. In general, zero-line crossovers tend to be more reliable than regular MACD crossovers. But once again, you should wait for additional confirmation before placing a trade. Application number 4, MACD returning to the zero line. In a strong trending market, the MACD line often pulls back toward the zero line before price makes its next breakout. So in an uptrend, when the MACD line retraces toward the zero line, that can be a great area to look for buy opportunities. But, and this is key, don't just buy automatically every time the MACD touches zero. You should wait until the MACD line crosses back above the signal line before entering your long trade. Similarly, in a strong downtrend, when the MACD line returns to the zero line, it may be a great setup to look for short opportunities. In this case, wait for the MACD line to cross below the signal line, and then place your short entry right at the crossover. Now let's move on to the final application of the MACD indicator. Application number 5, divergence. Divergence is a powerful signal of potential trend reversals, and it can be extremely helpful in spotting early changes in market direction. Divergence occurs when price action and the MACD indicator tell two different stories. We'll use the MACD histogram to identify these divergences. There are two main types, bullish divergence and bearish divergence. Let's start with bullish divergence. A bullish divergence happens when price forms a new lower low, but the MACD forms a higher low. This suggests that the momentum behind the latest price drop is weaker than the previous one. It's a strong clue that selling pressure is fading, and a sideways move or a full reversal could happen soon. Here's an example. In this chart, the market is in a downtrend, and price creates a new low that's lower than the previous one. But take a look at the MACD. It forms a higher low instead. That's a clear bullish divergence. It shows that bearish momentum is weakening, and it signals a possible trend reversal. This becomes a potential entry point for a buy trade. Now let's take a look at bearish divergence. Bearish divergence occurs when price forms a new higher high, but the MACD forms a lower high. This signals that the momentum behind the latest price rally is weaker than the previous one. In other words, buying pressure is fading, and the market may soon move sideways or even reverse. Here's an example. The price is in an uptrend and creates a higher high. However, on the MACD, we see a lower high. This is a clear bearish divergence, a warning that the buying strength is weakening. Many traders struggle to identify good entry points when a divergence shows up. But don't worry. In the next section on trading strategies, we'll show you powerful techniques to pinpoint high-probability trade entries. Now, one important note about divergence. Divergences should be clearly visible on the chart. You should be able to spot them easily with the naked eye. Let's compare two examples. In this one, price makes a higher high, and the MACD shows a lower high, but the difference is minimal. These highs are almost the same, so this is considered a weak or unclear divergence. In contrast, here we have a strong and clear divergence. Price forms a significantly higher high, while the MACD clearly forms a lower high. This type of divergence is much more reliable and can serve as a strong reversal signal. Now let's talk about trading strategies that can be built around the MACD indicator. The first two strategies are reversal setups, while the last one is a trend-following setup. These three strategies will help you trade effectively in any market condition. Use the reversal setups when the market is range-bound, and use the trend-following setup when the market is trending strongly. Strategy 1. Divergence at support or resistance levels. As we discussed earlier, divergence is a strong signal of a potential reversal. But not all divergences should be traded. We need to identify potential reversal zones and only trade when a clear divergence occurs around those areas. For this strategy, we'll combine divergence with key support and resistance levels. First, we identify major support or resistance zones on the higher time frame. Then, we wait for a divergence signal on the lower time frame. Here's an example. We're looking at the weekly chart. Price moved up and then reversed, so we draw a resistance level here. When the price returns to this resistance level, we expect a possible reversal to the downside. So we switch to the daily chart to look for divergence. Here's the same price action on the daily time frame. As price approaches resistance, it forms a higher high. But on the MACD, we see a lower high. This is a clear bearish divergence. It tells us that the selling pressure is building as price nears resistance. When we combine a strong resistance level with a bearish divergence, it becomes a high probability trade setup. In this case, we should be looking for a short selling opportunity. For the entry technique, we need to identify the lowest point between the two MACD peaks. Here are the two peaks, and this is the lowest point between them. We draw a straight line starting from this low. Then we wait for the MACD histogram to break above this line. This histogram bar breaks the line, so we enter a short position on the corresponding candlestick. As you can see, the price dropped sharply after the entry. Here's another example. This time for a long setup. We're looking at the weekly chart. Price reversed upward from here, so we mark this level as a support zone. When price returns to this zone, we expect it to find support and bounce back up. Now, we switch to the daily chart and look for a bullish divergence. Price makes a lower low as it approaches the support area. But on the MACD, we see a higher low, which is a clear bullish divergence. This tells us that selling momentum is weakening. So we consider this a high probability buy opportunity. Next, we mark the highest point between the two MACD lows and draw a straight line from that point. As soon as the histogram breaks above this line, we enter a buy order. And as you can see, the price makes a strong upward move after that. Now let's move on to strategy 2, MACD divergence combined with Bollinger Bands. Bollinger Bands are a popular indicator used by many traders to spot potential reversals. In theory, price is expected to stay within the bands about 90% of the time. So whenever price moves outside the bands, we can expect it to reverse and return inside. If price breaks above the upper band, we expect a bearish reversal. If price breaks below the lower band, we expect a bullish reversal. We'll combine this method with MACD divergence. But first, let's adjust the Bollinger Band settings. Set the length to 200 and keep the standard deviation at 2, so we get Bollinger Bands based on the 200 period moving average. Here's a short setup using this strategy. We can see that price is in a strong uptrend, staying above the upper Bollinger Band for a long time. Now we expect a reversal to the downside. So we look for a bearish divergence. Price forms a higher high, but the MACD histogram prints a lower high. This is a clear bearish divergence. So now we have a short opportunity. For this strategy, our entry signal comes on the first candle that closes back inside the Bollinger Bands. This is the candle where we enter a short trade. As you can see, the price made a sharp drop after our entry. Now let's continue with a long setup using this strategy. At first, we saw a strong downtrend, with price staying below the lower Bollinger Band for quite some time. Naturally, we start expecting a bullish reversal. Near the end of the move, we notice price continues to form lower lows, but the MACD histogram is printing higher lows. This is a clear bullish divergence. We now have a combination of MACD divergence and Bollinger Bands, which tells us that selling pressure is fading and buyers are starting to step in. This sets the stage for a potential reversal to the upside, so we start looking for a long opportunity. Our entry signal comes on the first candle that closes back inside the Bollinger Bands. That's where we enter a buy trade. And as you can see, price makes a strong move up after the entry. Strategy 3. Roll reversal zones, combined with MACD, pull back to the zero line. If you're familiar with support and resistance concepts, you probably know that their roles can switch. This means a resistance level can become support once it's broken, and a support level can act as resistance after it's breached. We call these areas roll reversal zones, and they often become high probability zones for trend continuation trades. Now let's bring the MACD indicator into the mix. In this example, price is in a strong uptrend. We identify a resistance level here where price previously reversed. Eventually, price breaks above that level, turning it into a support zone. As price pulls back to retest this new support, we watch how MACD behaves. We notice the MACD line pulls back toward or slightly below the zero line, indicating a healthy correction within the uptrend, not a reversal. When these two conditions align, a roll reversal zone and a MACD pullback to zero, it creates a high probability buy setup. As seen in this example, entering a buy trade at the support zone leads to a strong upward move. Here's an example of a sell trade using this strategy. In this case, the price is in a strong downtrend. This swing low allows us to identify a support level. Later, price breaks below this support level, and it now acts as resistance. When the price pulls back to this new resistance zone, we expect a strong move downward. At the same time, we notice that the MACD line has pulled back above the zero line, which often signals a temporary correction within a broader downtrend. So here we have two key elements. 1. A roll reversal zone, support turned resistance. 2. A MACD pullback to above the zero line. To top it off, we spot a bearish pin bar candlestick pattern right at the resistance zone. This gives us a high confidence sell signal, and we take the trade. As you can see, the price dropped sharply afterward. In this video, we've covered the MACD indicator and its practical uses in trading. With the three MACD-based trading strategies we've discussed, you'll be better equipped to trade in any market condition, whether it's trending or ranging. Let us know what you think in the comments. If you found this video helpful, make sure to like and subscribe so you won't miss any of our upcoming content.